Welcome back. We are now busy with Unit 2.2. In the next session, we'll be discussing financial markets. Right, the financial market is a market in which people trade financial securities and derivatives at low transaction cost. Securities include stocks and bonds and precious metals. The term market is sometimes used for what are more strictly exchanges, organizations that fluctuate the trade in the financial securities, for example, a stock exchange or a commodity exchange. It may be a physical location such as the New York Stock Exchange, the London Stock Exchange, the LSE, or the Johannesburg Stock Exchange, the JSE, or the BSE, or it could be an electronic system such as the NASDAQ. Much trading of stocks takes place on an exchange. Still, corporate actions, mergers, spin-offs are outside of an exchange, while any other two companies or people, for whatever reason, may agree to sell stock from the one to the other without using an exchange. Right, trading of currencies and bonds is primarily on a bilateral basis, although some bonds trade on a stock exchange. And people are building electronic systems for these as well to stock exchanges. Financial interest-bearing instrument markets are normally divided into, number one, a money market or a capital market. Now let's have a look at understanding the money market. The money market provides short-term funds to borrowers from government and corporate sectors. Short-term typically means a period not exceeding 12 months. The investors are financial institutions as well as other lenders who have short-term surplus funds available. The instruments of the money market offer high liquidity and low risk. The money market can be divided into a primary market and a secondary market. The primary market refers to the initial issue of the money market instrument. Instruments of the money market are negotiable and transferable. Payments are made to the bearer of the relevant document, and for this reason, there is also a secondary market. The other participants in the money market is the South African Reserve Bank. The South African Reserve Bank, or SARB, conducts monetary policy within an inflation targeting framework. The current target for the average inflation to be within a target range between 3 and 6%. The South African Reserve Bank regards its primary goal in the South African economy system as the achievement and maintenance of price stability. However, the bank's role has recently been extended to consider the impact of its policies on economic growth. Other participants in the money market is the Corporation for Public Deposits. The Corporation for Public Deposits is a subsidiary of the South African Reserve Bank, accepts deposits from a broad range of sources. The corporation accepts minimum amounts and in a liquid market act as a borrower of last resort. Most of its funds go to the public sector and are invested in, for example, treasury bills, land bank bills, promissory notes of the Industrial Development Corporation or the IDC. The Public Investment Corporation, the traditional role of the Public Investment Corporation or the PIC is to receive long-term deposits from public sector for long-term investment. It manages money for government, provincial administration, the South African Transport Services, the Post Office, Social Security, pension and provident funds, and universities and public corporation funds in South Africa. The Industrial Development Corporation, or the IDC, the Industrial Corporation is a public corporation that provides specialized finance for industrial products and development of tourism. Loans are payable over periods between 3 and 10 years. Then you get the Land or the Agricultural Bank. Advances are made to farmers and agricultural cooperatives by the Land Bank. Funds are raised through an issue of land bank bills. Deposits are received from the farmers, the cooperatives, control boards, and certain other financial institutions. Then other money market instruments is treasury bills, or TB. Involves a short-term debt issued by the government, which usually have maturities of 91 or 182 days. Treasury bills are issued for two main reasons: to fund part of the government budget deficit for monetary policy purposes. They are an essential source of information, as interest rates on treasury bills serves as a benchmark indicator of money market conditions and act as a reference rate for calculations of interest rates on several other money market assets. Financial institutions consider these bills as liquid assets, and because they involve government debt, they offer excellent security. They are readily negotiable and offer good short-term investment opportunities. Treasury bills are discount instruments. The tender is sold at a discounted rate that is worked out as a percentage per annum of the redemption price. The discount acts as insurance of interest to be earned on loan to the value of the discounted price paid by the investor. The other money market instruments is call deposits. Its money is deposited in an interest-bearing account and can be called back on demand. Typically, the more significant amount invested, the higher the interest rate. Interest rates are subject to daily fluctuations. Interest is calculated on a balance of daily balance and paid monthly. Then another form of money market instrument is notice deposits. There is no specific date for the deposited funds, but a period of notice must be given before the withdrawal of the funds. Rates are increased automatically, but the investor are informed of any decreases with the same period of notification before the decrease. Then other instruments is bankers' acceptances, or they call it also a BA, is a bill of exchange drawn on an acceptance by a bank. The maturity period is usually between 30 and 120 days. The most popular period is 90 days. The face value is the amount the investor will receive on the maturity date. Short-term finance may come in the form of an overdraft or a bank acceptance. The interest rate will dictate which option is most cost-effective. The fixed rate of a banker's acceptance is preferable to fluctuating interest rates of an overdraft, but if the funds are needed on only intermittently over, let's say, 30 or 120-day period, an overdraft may prove to be cheaper. A drawer applies for a credit acceptance from a bank. The banker accepts the bill by signing across the face of the bills. The drawer can then sell them at the ruling discount price. Bankers' acceptance are no longer issued or traded in South Africa, though they are used in other countries. And another money market instrument is promissory notes. A promissory note is an unconditional promise in writing made by one person to another, signed by the maker, who agrees to pay on demand or at a fixed or determinable future time a certain sum to be specified person or order or bearer. A bank is usually approached to endorse the note. Banks will accept a promissory note in lieu of funds as an alternative to overdrafts or loans. A promissory note does not affect the bank's liquid assets in the way that these alternatives do. The bank discounts the note on the open market and the bearer is then paid the face value. The debt will appear as a liability only on the maturity date. Banks must reflect their dealings in promissory notes on their balance sheets. Then another market instrument is negotiable certificates of deposits, or NCDs, is issued as a receipt in bearer form for time deposits. They are liquid as a negotiable asset and offer a market-related rate or interest. They are payable to the bearer, but may also be made out to a specific person. The institution issuing the certificate undertakes to pay the amount of the deposit plus interest to the holder on maturity. They are normally issued for less than a year. but banks do tailor the maturity period to the needs of their clients. NCDs are not eligible for a rediscount at the Reserve Bank, but they remain prevalent due to their higher yields, negotiability, and their status as a claim on a bank. Right, let's look at understanding the capital market. Capital markets, as with the money market, the bond market, or capital, the market has a primary and a secondary market. In the capital market, securities can be issued by the borrower directly to lenders, the primary market, and they are sold and purchased by either role player in the secondary market. Institutions in the capital market, the following are institutions that issues bonds: the South African Reserve Bank, or SARB; public corporations, for example Eskom; public utilities, for example the Rand Water Board; municipalities, and other listed companies. The capital markets have three areas in which bonds are issued, and they are therefore the private sector. Companies need funds to finance long-term investments. They do this by issuing of shares, corporate bonds, debentures, and rights issues. The central government, the government needs long-term funding to finance its expenditure. It's done by issuing long-term bonds. As an investment with the government is the safest investment one can make. The interest paid by the government on its bonds will be less than paid by other borrowers. Here we are talking about risk that the borrower may default on payment. It does not consider interest rate or inflation risk. Then municipalities and public corporations, these issue bonds to finance long-term expansion projects. Right, let's look at the role players in the capital market. The following are role players in the capital market. Banks act as deposit takers who offer mortgage finance for housing. They also help provide funds for capital investments and working capital for business. Insurance companies are an essential channel through which personal savings by way of insurance premiums can be used as a source of funds for the public sector. And then the stock exchange plays a significant role in listing new bonds. Let's look at the type of bonds. There are various types of bonds. Interest-bearing investments provide the investor with a regular biannual interest rate payment and the original capital invested at maturity. On the other hand, discounted instruments do not provide the investor with a regular income, but gives a discount on the initial nominal amount. The most common types of bonds are coupon bonds. Coupon bonds, also called straight or vanilla bonds, are directly speaking and an IOU, that obligation the issuer to pay the bondholder a fixed sum of money at the bond's maturity, along with regular periodic interest payments during the life of the bond. Your coupon bonds, if we continue with that, in addition to a straight bond component, bonds can have additional features attached. These features are sometimes designed to enhance a bond's appeal to the investor and the marketability. For example, convertible bonds have a conversion feature that grants bondholders the right to convert their bonds into shares of the issuing company. Bonds may have a call or a put option embedded in them. A callable bond grants the issuer the right to repurchase the bond, for example, if the interest rate decreases. A bond with a put option has a feature that grants the bondholder the right to sell their bond back to the issuer at a special put price. And let's look at an example. We've got investor A who purchased a bond on the 1st of January 2015 with a maturing date of 31st of December 2020. The maturity value of the bond is 1 million. Investor A invests 1 million on the 1st of January of 2007 and will receive a regular biannual interest payment, otherwise known as a coupon rate, for the period of the investment. At maturity, investor A will receive his original R1 million back. Right, let's look at zero coupon bonds. The zero coupon bond are discount bonds that are not payable, that do not pay periodic interest. They pay the par value at maturity, and the interest results from the fact that zero coupon bonds are initially sold at a price below their par value. So if we look at investor B, in an example, purchase a zero coupon bond on the 1st of January 2015 with the maturity date of 31st of December 2020. Investor B will only invest, let's say, 700,000 on the 1st of January 2007 and will not receive any income during the period of investment. The formula is used to calculate the exact amount to be discounted based on the current and the future value of the coupon rate and nominal amount. This phenomenon is called discounting. Right, inflation-linked bonds. Inflation-linked bonds pay an interest rate that adjusts to keep track with inflation. The amount that is repaid on maturity would also be adjusted for inflation. It contrasts with the vanilla bond, where the rate of interest is fixed for the life of the bond, and the amount paid out on maturity is known when one invests in the bond. For example, if the coupon on the bond is 8% per annum and the investment is 1 million, the interest paid per annum is 80,000. If the inflation the next year is 5%, the capital value of the bond is adjusted to 1,050,000. The coupon rate of 8% per annum remains unchanged, but it is payable on the higher capital value. It is therefore 84,000, which is the 1,050,000 times 8%. Inflation-linked bonds are attractive for those investors who want to protect their investment from the impact of inflation. However, the yields are usually initially lower compared to that of a vanilla bond. Right, let's have a look at the difference between an inflation-linked bond and a vanilla bond. In the table below, we summarize the differences. Inflation-linked bond, the bond provides a real return over the long term, which is known when the bond are purchased, where the vanilla bond provides a steady nominal return over the long term, which is known when the bond is purchased. The inflation-linked bond, the nominal return received would depend upon the rate of inflation. The inflation figure is used is the CPI, Consumer Price Index, where the vanilla bond, the real rate received would depend upon the rate of inflation. In the inflation-linked bond, the nominal interest rate varies depending upon the rate of inflation. The real interest rate for the purchase remains constant. In a vanilla bond, the interest rate is fixed for the life of the bond. If we back at the inflation-linked bond, the end value is not fixed, and the value depends upon the rate of inflation. Where in the vanilla bond, the end value is known at the time of purchase. Right, if we look at the taxation of inflation-linked bonds, Section 24J of the Income Tax Act states that interest on bonds is taxable on a yield to maturity basis. It is important to note that both coupon payments and the difference between the acquisition cost and the bond's nominal value are defined as an interest and taxable for income tax purposes. A CPI, Consumer Price Index inflation-linked bond, is a variable rate instrument for Section 24J. A variable rate is a rate determined concerning an interest or indexation rate or similar factor, being a rate or factor that varies during the instrument's term. Furthermore, all bonds are included in the definition of an instrument for Section 24J. The effect of these provisions is that amounts in respect of adjustment for inflation in the case of CPI bonds will be treated as interest and subject to the accrual rules contained in Section 24J. The full amount of the inflation adjustment is therefore taxable. Right, if we look at calculating the present value of a bond, the price of a bond is determined by the level of interest rate currently in the country. Since a bond has a fixed interest rate for perhaps 20 years, interest rates in the country vary above or below that fixed rate during its lifetime. If a bond has, let's say, a 15% coupon interest rate and a current rate decreases to 13%, the value of the instrument rises as the investor cannot receive such a high interest rate anywhere else in the marketplace. Investors are therefore prepared to pay more for the face value of that bond. Thus, the price of a bond rises as the current market interest rate falls and vice versa. Therefore, we can say that bonds have a negative relationship with interest rates as illustrated graphically in the following diagram. The bond purchase price is calculated by finding the present value of these payments, which is by discounting the payment at the current interest rate. When asked to perform calculations regarding bonds, the most common will be to calculate the present value of the bond or the interest rate, which can be done by using a financial calculator. Now, here's just an example of how this calculation is done. An investor wishes to invest in an Eskom bond with a par value of 1 million. The coupon rate is 8.5%, which is a term of maturity of 5 years, with a purchase price of the bond if the current interest rate is 8%. As the coupon payment will take place at the end of every 6 months, the calculator needs to be in end mode. There are two methods to calculate the bond price. Now let's look at the first method. The first one is calculated on 1 period per year. That's the 1P/YR as period per year. The term in this instance is 5 times 2, which is 10. The interest per year is 8%, divided by 2, because we've got 2 periods here, equals 4%. Your payment that you put into your financial calculator is 42,500. The future value is the R1,000,000 that we are investing, and the present value will then work out on 1,020,277. The second method would be to use 2 periods, not 1 period, but 2 periods per year. The N would then be 5 times 2 equals 10. There you'll use the 5 shift N button on your calculator. Your interest rate per year would be 8%, your payment 42,500, future value 1 million, and the present value will then come to the same amount of 1,020,22. Right, just to have a look at all these functions on your calculator. N stands for number of interest periods. So that's your term or your period over which you calculate. So method 1 implies 4% over each of the period or time, which is N equals 10 6-month periods, while method 2 tells the calculator to split the 8% up to 2 times per year over the term, which is 10 years. The PM stands for payment, and that's semi-annual coupon payment that's made. Y stands for your discount rate. Future value is your par value or selling price at the end of an assumed holding period. Your PV is present value of all future cash flows and the market value of the bond. And then PMT payment is half yearly interest on the bond. For example, 1 million times 8.5% divided by 2 to get to the half yearly. The investor will thus pay 1,020,277 today for investment that matures in 5 years, and that will give him a fixed income of 85,000 per annum until maturity, at which point he will then receive the nominal value of 1 million rand back. Right, so if we continue with the example, so assume the investor wishes to purchase the same bond in the example above, except that the current interest rates are 9%. What is the market value of the bond? And now we use 2 periods per year, as in the second example, where N, the term is 5 times 2 equals 10-year term. IR 9%, payment 42,500, future value 1 million, and then your present value will be 980,218. This example illustrates the principle that when current interest rates rise above the coupon interest rate, then the price of the bond falls below the nominal value. The nominal value being the 1 million, and it's now fallen down to 980,218. Right, let's have a look at the advantages and disadvantages of bonds. Bonds pay a higher and steadier income than cash. Government is seen as a secure and safe credit risk. Bonds are generally less volatile than equities. Income is paid out regularly. Bonds can offer returns above inflation. The disadvantages: in the short term, bonds can make a capital loss, although usually less than equities. And bonds may also be subject to capital gains tax, and the interest income is also taxable. What is the risk of bonds? There are various types of bonds. Interest-bearing investment provide the investor with an asset class that historically has been considered less volatile than equities. It is discussed more fully in the section on asset class returns when we discuss it later. Interest rate risk refers to the effect of changes in the current interest rate of bond values. When interest rates rise, bond values fall. You see that inverse relationship there. It is the source of interest rate risk, which is approximated by a measure called duration. The yield curve risk arises from the possibility of changes in the shape of the yield curve, while duration is a useful measure of interest rate risk for equal changes in yield at every maturity. Changes in the shape of the yield curve means that yields change by different amounts for bonds with different maturities. Right, your call risk arises from the fact that when interest rates fall, a callable bond investor principal may be returned and must be reinvested at the new lower rates. When interest rates are more volatile, callable bonds have relatively more call risk because of an increased probability of bond yields falling to a level where the bond will be called. Your reinvestment risk refers to the fact that when interest rates fall, the cash flows, both interest and principal from the bond, must be reinvested at a lower rate, reducing the returns an investor will earn. Note that investors can be forced with a choice between reinvestment risk and price risk. A non-callable zero-coupon bond has no reinvestment risk over its life, since there are no cash flow to reinvest, but a zero-coupon bond has more interest rate risk than a coupon bond of the same maturity. Therefore, a coupon bond will have more reinvestment risk and less price risk. Right, credit risk is the risk that the creditworthiness of a bond issuer will deteriorate, increasing the required returns and decrease the bond's value. Liquidity risk is the risk that the sale of a bond must be made at a price less than the prevailing market values because of a lack of liquidity for a particular issue. Inflation risk refers to the possibility that prices of goods and services will increase more than expected, since fixed coupon bonds pay a constant periodic stream of interest income. An increased price level decreases the amount of real goods and services that bond payments will purchase. Inflation risk is thus also referred to as purchasing power risk. When expected inflation increases, the resulting increase in nominal rates and required yields will decrease the value of the previously issued bonds. And then volatility risk is present for bonds that have embedded options, such as a call or put option. Changes in interest rate volatility affects the value of these options and therefore affects the value of the bond with embedded options. And then the last risk that we're going to list here is sovereign risk. Risk to changes in government attitudes and policies towards their payment and servicing of debt. Governments may impose restrictions on the outflow of foreign exchange to service debt by their private borrowers. Right, that concludes this session on financial markets, which was Unit 2.2. In the next session, we will look at Unit 2.3, where we will discuss equity markets. So thank you for attending this part of the session. See you in the next session, 2.3, where we will discuss equity markets.